The ICT Trading Strategy Bible Institutional Concepts for Forex, Crypto, and Indices full audiobook. In this video, you'll get a complete deep dive into ICT smart money concepts, including market structure, liquidity, order blocks, fair value gaps, and everything you need to trade like the institutions. Whether you're a beginner or an experienced trader, this audiobook will help you master the principles that move the markets. Before we begin, don't forget to like this video, subscribe to the channel, and hit the bell icon so you never miss powerful trading content like this. Let's get started. ICT Trading Strategy Bible Institutional Concepts for Forex, Crypto, Indices. Introduction. Decoding ICT, the blueprint of smart money trading. Financial markets have long captivated the human spirit, a place where ambition, skill, and discipline collide in the pursuit of opportunity. Every day, millions of traders step into this arena armed with strategies they believe will help them outweed the market. Yet, for most, the path is one of frustration, inconsistency, and elusive profits. The truth is simple but often overlooked: markets are not random. They are engineered by those who possess the knowledge and capital to shape price, the smart money. This book is dedicated to unlocking the principles behind smart money trading as taught by Michael Huddleston, known globally as the Inner Circle Trader, ICT. Michael Huddleston's teachings have reshaped modern price action trading. His work exposes how large institutions, banks, and funds, the entities that truly move the markets, operate beneath the surface. He shows that price does not move to satisfy retail indicators or chart patterns. Instead, price is driven by the hunt for liquidity, stop losses, pending orders, and trap traders' positions. ICT provides a framework to understand these dynamics and trade in alignment with the forces that actually control price. Why ICT trading matters. The majority of traders rely on conventional tools, oscillators, moving averages, candlestick patterns, in the hope of predicting market direction. While these tools can offer context, they often leave traders vulnerable to the manipulations of larger players. ICT invites you to think differently, to see the market through the lens of those who create the moves, not those who react to them. Through the ICT approach, you will learn to identify liquidity pools where price is drawn like a magnet, recognize the footprints of institutional activity through order blocks, understand how price rebalances itself through fair value gaps and inefficiencies. Align your entries and exits with the key sessions and timings where smart money operates. The purpose of this book. This book is not designed to be a quick fix or a compilation of recycled patterns. Instead, it offers a deep, structured exploration of the inner circle trader methodology. Whether you are a beginner seeking clarity or a struggling trader aiming to break through to consistency, this book will serve as your guide. By the final chapter, you will have gained a precise understanding of ICT's core concepts, practical methods for identifying high-probability trade setups, the ability to spot and avoid the trap set for retail traders, a framework for building a repeatable, disciplined trading plan, a journey of mastery. Trading ICT concepts is not a shortcut to instant wealth. It is a craft, one that requires study, practice, and emotional resilience. Those who approach it with seriousness and dedication, however, will find that it offers unparalleled insight into the true workings of price. The chapters ahead will take you step by step through the architecture of smart money trading. You will learn not only what to look for on the chart, but why price behaves as it does. You will discover how to think like the professionals and align your trades with the forces that drive the market. Chapter 1. The Smart Money versus Retail Perspective. In every financial market, whether it be Forex, futures, equities, or commodities, there exists an undeniable divide. On one side is retail money, the collective of individual traders, small funds, and speculators who seek to profit from price movements. On the other side is smart money, the institutional giants, central banks, hedge funds, and market makers whose capital and strategies shape the market's very structure. To trade successfully, one must stop thinking like retail and begin thinking like smart money. This chapter explores how institutions move markets, and how retail traders are so often drawn into traps laid by these larger players. How institutions move markets. Institutions, including major banks, hedge funds, central banks, and large trading firms, are the true forces behind market movement. Unlike retail traders whose trades are small and have no real influence on price, institutions deal in volumes so large that they must take extreme care in how they enter and exit the market. If they were to place their full position at once, the sheer size of their orders would move price against them, leading to poor fills, slippage, and higher costs. This means institutions do not simply react to price, they create the movement of price, manipulating it to serve their objectives. One of the primary ways institutions move markets is through the deliberate hunting of liquidity. Every transaction in the market requires a buyer and a seller. Institutions cannot execute massive positions without finding counterparties on the opposite side of their trade. To locate this liquidity, they target areas on the chart where large clusters of stop losses and pending orders are likely to sit. These liquidity pools are often found above key highs, below key lows, or around well-known support and resistance levels. Institutions drive price to these areas, not randomly, but with the specific goal of triggering retail stop losses or encouraging retail traders to enter the market at just the wrong moment. In doing so, they are able to quietly fill their large orders. Institutions also move markets through deception. They cannot openly reveal their intentions, because if the rest of the market knew what they were doing, price would race ahead and spoil their plan. Instead, institutions use tactics designed to mislead and manipulate. They will often create stop hunts, deliberately pushing price beyond key highs or lows to flush out stop losses and cause panic among retail traders. False breakouts are another common method. Institutions allow price to breach a major level, knowing that this will lure retail traders into buying or selling in the wrong direction. After these traders are trapped, price swiftly reverses, leaving them at a loss. Similarly, institutions may keep price contained within a tight range for hours or even days. During this time, they quietly accumulate or distribute their positions without drawing attention. When they are ready, the market breaks out of the range in a powerful move that catches most traders off guard. Timing is another key tool institutions use to move markets. Their activity is concentrated during the sessions that offer the most liquidity, particularly the London and New York trading sessions. During the London session, institutions often lay the groundwork for major moves, creating traps, stop hunts, and false signals. It is in the New York session, however, that the true directional move often plays out, fueled by the liquidity gathered earlier. Retail traders who enter blindly without an awareness of these timing dynamics frequently fall victim to these engineered setups, entering at the worst possible moments. Despite their efforts to conceal their activity, institutions inevitably leave a footprint on the chart, clues that the observant trader can learn to recognize. For example, order blocks mark the final up or down candle before a significant shift in price direction, often indicating where institutions entered the market. Fair value gaps or imbalances appear where price has moved too rapidly, leaving a void that is often revisited as price seeks to rebalance. Sharp breaks of market structure, particularly after a liquidity raid, can also signal that institutions have shifted their intent and that a new trend may be forming. Finally, institutional movement typically unfolds in distinct phases. First comes the accumulation or manipulation phase, during which price moves sideways, false breakouts occur, and liquidity is gathered. Next is the expansion phase, when price makes a sharp, sustained move in the intended direction as positions are fully committed. This is followed by the distribution phase, when institutions begin exiting their positions, often setting the stage for a new accumulation period and the next leg of market movement. In short, institutions move markets not by chance or guesswork, but by engineering price action to serve their needs. They create the conditions required to enter and exit massive positions while exploiting the predictability of retail trader behavior. For traders who seek to align with smart money rather than trade against it, the task is to study where liquidity lies, recognize deception when it occurs, and learn to interpret the subtle footprints that institutions leave behind. Understanding retail trader traps. Retail traders, unlike institutions, approach the market with limited information and smaller capital. This means they often rely on conventional tools, indicators, patterns, and price levels that seem logical on the surface but make their actions predictable to the smart money operators who move the market. Institutions are well aware of the common habits of retail traders, and they design their strategies to exploit these habits. The result is a series of traps that pull retail traders into poor trades at the wrong times in the wrong places. Understanding these traps is essential for any trader hoping to survive and thrive in today's markets. One of the most common traps is the breakout trap. Retail traders are taught to buy when price breaks above resistance or to sell when price breaks below support. The logic seems sound. A breakout should indicate strong momentum and a new trend. However, institutions know this behavior and will often push price just beyond these key levels, triggering retail buy or sell orders. Once retail traders are committed, price quickly reverses, leaving them trapped in losing positions. What looked like the start of a strong move was actually a false breakout engineered to generate liquidity for institutional entries. Another frequent trap lies in the illusion of support and resistance. Retail traders place great faith in these horizontal levels, believing that price will reliably bounce or reverse at these zones. Institutions, on the other hand, see these levels as magnets for liquidity. Clusters of stop losses accumulate at or beyond support and resistance, creating the perfect targets for a liquidity grab. Institutions will drive price through these levels, triggering stops, forcing retail traders out of the market, and using that liquidity to fill large orders. The very levels retail traders trust most are the levels that institutions exploit to execute their plans. Over-reliance on indicators is another major pitfall. Retail traders often depend on tools like RSI, MACD, or moving averages, assuming that when these indicators signal overbought or oversold conditions or a crossover, price will behave in a predictable way. But indicators lag behind price. By the time they flash a signal, institutions have typically already entered or are preparing to exit. Retail traders who act on these signals are always a step behind, chasing moves that have already happened while institutions position themselves for the next phase. Perhaps the most dangerous trap of all is the cycle of fear and greed that governs retail decision-making. When price makes a strong move, retail traders often jump in late, driven by the fear of missing out. When price pulls back or reverses suddenly, they panic and exit at a loss. Institutions count on these emotional reactions. They push price far enough to spark greed, drawing traders in at bad levels, and then reverse it sharply enough to provoke fear, forcing traders to exit just as price is about to move in the intended direction. Ultimately, the retail trader trap is not just about poor tools or wrong levels, it is about predictability. Retail traders who follow conventional wisdom without understanding the deeper game make themselves easy prey for the institutions that control price. To break free from these traps, traders must shift their mindset. They must stop focusing on surface signals and start thinking like smart money, asking where liquidity lies, where the majority is positioned, and where price is likely to go before the obvious move begins. Only then can they stop being victims of manipulation and start aligning themselves with the forces that truly move the market. Chapter 2. Market Structure Mastery. At the heart of every ICT-based trading strategy lies one crucial skill: reading and understanding market structure. Market structure is the map that reveals the underlying intentions of price. It shows whether the market is trending or consolidating, and it provides clues about when the smart money has shifted its bias. Where most retail traders see noise, the trader who understands market structure sees purpose. This chapter will guide you through the key components of market structure, focusing on break of structure, BS, market structure shift, MSS or MSB, and how to apply these concepts practically on the chart. Let's break down break of structure. A break of structure, or BS, is one of the most important signals a trader can learn to identify. It represents a critical moment when the market reveals that the existing trend may be losing strength and that a potential shift in direction is beginning. At its core, A BOS occurs when price violates a key level that had previously defined the market's trend. In an uptrend, price consistently forms higher highs and higher lows. The higher lows act as support points, and as long as they hold, the uptrend remains intact. When price breaks below one of these higher lows, it signals that buyers are no longer fully in control and that bearish pressure is starting to take over. This decisive move below a structural higher low is what traders call a break of structure. In a downtrend, the opposite is true. Price forms lower highs and lower lows as it moves downward. The lower highs act as resistance points, and as long as price respects these lower highs, the downtrend is considered valid. When price breaks above a previous lower high, it suggests that sellers are losing control and that buyers are beginning to overpower them. This break above a lower high marks the BOS in a bearish market. The BOS signals that the existing order of price, whether bullish or bearish, has been disrupted and that the market's intent may be changing. Importantly, not every break of a high or low is a meaningful BOS. Smart money understands where retail traders place their stop losses, and price will often spike beyond these levels simply to collect liquidity before resuming its original direction. A true BS is confirmed not just by the break itself but by the strength and commitment of price afterward. When price breaks a key structural level and follows through with continued movement in that new direction, traders can have greater confidence that a shift in control has occurred. Recognizing a BS in real time allows traders to adjust their bias before the majority of the market catches on. Rather than continuing to trade in the direction of the old trend, they can begin looking for signs of accumulation or distribution by smart money, as well as potential new entry points that align with the emerging direction. The break of structure is not the end of the story, but the first chapter in the unfolding narrative of a market reversal. Traders who master the art of spotting a true BS position themselves ahead of the crowd, ready to trade with rather than against the forces that truly drive price. Market structure shift MSS/MSB. A market structure shift, often referred to as MSS or MSB market structure break, is a powerful confirmation that the market has transitioned from one directional bias to another. While a break of structure BS is the first crack in the foundation of an existing trend, a market structure shift represents the moment when the market firmly establishes a new intention. It is the point at which price begins building structure in the opposite direction, offering traders clarity that the trend has truly changed. In an uptrend, price moves by forming a sequence of higher highs and higher lows. The strength of the trend is defined by this pattern as buyers continue to push price higher while defending the lows. When price breaks below a higher low, the BOS, it is the first warning sign that the uptrend is weakening. But the real shift occurs when price doesn't just break that level but follows through by forming a lower high and then a lower low. This sequence of lower highs and lower lows signals that sellers have taken control and the market has transitioned into a bearish structure. This is the market structure shift, the confirmation that a new trend is underway. The same logic applies in a downtrend. Price descends through a series of lower highs and lower lows. The downtrend remains intact as long as these levels are respected. A break above a lower high is the BOS, a sign that bearish strength is faltering. But it is when price forms a higher low and then a higher high that the true market structure shift is confirmed. At this point, buyers have seized control and the market begins to build bullish structure. What makes the MSS so valuable to traders is that it marks the transition from uncertainty to clarity. The BOS tells us that the old trend is in danger. The MSS tells us that a new trend has arrived. For traders, this is the moment to recalibrate, to stop trading in the direction of the previous trend and to begin seeking opportunities that align with the new bias. The MSS is also the point where smart money is most active as institutions accumulate or distribute positions to prepare for expansion in the new direction. Mastering the identification of the market structure shift is what allows traders to act ahead of the crowd. It keeps them from clinging to the remnants of a fading trend and positions them to align with the true drivers of price. When you can spot an MSS, you are no longer reacting blindly to price movement, you are reading the market's intention and preparing to trade with smart money, not against it. Here's a clear breakdown of practical examples of BS and MSS. To truly grasp the power of break of structure and market structure shift, it is helpful to walk through practical examples, the kind of scenarios that unfold on real charts and catch traders off guard if they are not paying attention to the story price is telling. Imagine a market that has been trending downward for several hours or even days. Price forms a clear sequence of lower highs and lower lows, each rally being sold off as sellers dominate the market. At first glance, it appears the downtrend is strong and intact. But then price approaches a prior lower high, a level where sellers previously defended the market and kept it moving lower. Suddenly, price surges above this lower high, breaking structure. This is the break of structure, the first sign that something in the market dynamic has changed. Sellers are no longer fully in control, and smart money may have begun accumulating long positions while the majority of retail traders are still focused on selling. At this stage, many inexperienced traders might immediately switch to buying, believing the downtrend is over the moment the lower high is breached. But the break of structure alone is not the full confirmation. Price could just as easily spike above that level to raid liquidity and then resume the downtrend. The wise trader waits for more evidence, for price to form a higher low, followed by a higher high. When this happens, the market has shifted from creating lower highs and lower lows to building higher highs and higher lows. This is the market structure shift, the true confirmation that the market has changed its bias and that buyers have taken control. The trader can now begin looking for a retracement into a smart money zone, perhaps an order block or a fair value gap, to enter in alignment with the new bullish structure. Consider another example in an uptrend. Price has been pushing higher, making higher highs and higher lows as buyers consistently drive the market upward. Retail traders are eager to buy every dip, believing the trend will continue indefinitely. But then price breaks below a recent higher low, the BOS. This break signals that the bullish structure is no longer intact. However, just as before, a single break is not enough. The market may have dipped below the low simply to clear out stops before resuming the uptrend. The trader waits. When price fails to reclaim bullish structure and instead forms a lower high, followed by a lower low, the market structure shift is confirmed. Now, what was once an uptrend has transitioned into a downtrend, and the smart trader begins to look for areas to sell on a pullback in harmony with the new bearish structure. These practical examples illustrate why patience and precision are critical. Break of structure is the alert, the flashing signal that the current trend is under threat. Market structure shift is the confirmation, the moment the market declares its new intention. Together, these concepts help the trader avoid being trapped on the wrong side of the market and instead align with the true flow of smart money activity. Chapter 3. Liquidity, the fuel of the market. At the core of every price movement is one simple truth: the market moves to seek and consume liquidity. Liquidity is the fuel that powers the market's engine. Without liquidity, price would stall, unable to progress or reverse. Smart money, the institutions, banks, and large players understands this better than anyone. They do not chase price randomly, nor do they rely on patterns or indicators the way retail traders do. Instead, they study where liquidity rests on the chart, knowing that these areas provide the necessary counterparties for them to enter and exit massive positions without revealing their true intentions. For traders hoping to align with smart money, learning to see liquidity as the market's fuel source is essential. Liquidity can broadly be divided into two types: buy-side liquidity and sell-side liquidity. Let's break this down. Buy-side and sell-side liquidity. Buy-side and sell-side liquidity form the foundation of how smart money views the market. They are not just abstract concepts, but essential components that explain why price moves the way it does. Every time price approaches a key level, whether a high or a low, it is doing so for a reason. It is drawn there by the presence of liquidity, the resting orders that provide the fuel institutions need to enter or exit their massive positions efficiently and discreetly. Buy-side liquidity refers to the pool of resting buy orders found above significant market highs. These buy orders often come from two main sources. First, they include the stop-loss orders placed by traders who are short. A trader who has sold the market expects price to move lower, but in case they are wrong, they place a stop-loss order just above the most recent high. Institutions know this, and they target these levels to force shorts out of their positions, collecting the liquidity provided when those stops are triggered. Second, buy-side liquidity includes breakout by stops, orders placed by traders looking to join a bullish move once price breaks above resistance. These traders hope to catch the momentum of what they believe is a true breakout. But often, this push above the high is not the start of a new trend. Instead, it is a move engineered by smart money to raid the liquidity resting above that level, fill large sell orders, and then reverse the market. On the opposite side lies sell-side liquidity. This liquidity gathers below key lows on the chart. It consists mainly of the stop-loss orders of traders who have bought the market, protecting their long positions in case price falls. Institutions are fully aware that beneath every obvious low sits a cluster of these stops, an easy source of liquidity that they can target when they want to enter large buy orders at discounted prices. In addition, sell-side liquidity includes breakout sell stops orders placed by traders hoping to catch a downside move once price breaks below a key support level. When price approaches these lows, smart money will often drive it just far enough to trigger these stops, collect the liquidity, and then send the market higher, leaving breakout sellers and long traders alike trapped in losing positions. Understanding buy-side and sell-side liquidity changes the way a trader reads the chart. Rather than seeing highs and lows as lines that price respects, the trader begins to see them as magnets that attract price because of the liquidity resting just beyond them. This perspective helps the trader stop reacting emotionally to breakouts and stop runs and instead anticipate where price is likely to go, not because of random chance, but because that is where the liquidity lies, waiting to be harvested by smart money. Liquidity pools and raids. Liquidity pools and raids are central to understanding how smart money navigates the market. A liquidity pool is simply a zone on the chart where a large concentration of resting orders has accumulated. These pools form because the majority of traders behave in predictable ways, placing their stop losses and pending orders at similar levels. Above swing highs, below swing lows, around obvious support and resistance levels, and near round psychological numbers. These are the areas where stop losses and breakout orders tend to cluster. These areas represent easy sources of liquidity for institutions which need counterparties to fill their massive orders. Instead of placing their trades at random points, smart money drives price toward these pools to collect the liquidity necessary for their plans. Price movement toward a liquidity pool is rarely accidental. Institutions engineer the market in such a way that price is drawn toward these zones, often appearing as though it is breaking out of a range, a trend line, or a key level. The reality is that the true goal is to tap into the pool of resting orders waiting at these levels. Once price reaches the liquidity pool, a raid occurs. A liquidity raid is a sharp, deliberate move beyond a key high or low designed to trigger stop losses and breakout orders. To the untrained eye, a liquidity raid looks like the start of a powerful breakout, the kind of move traders want to catch to ride the trend. But more often than not, this push is short-lived. Once the resting liquidity has been consumed, institutions use the fuel gathered to fill their large positions and reverse price in the opposite direction, leaving retail traders trapped. Liquidity raids are not random spikes or anomalies. They are part of a well-planned process by smart money to clear the market of weak hands and create the conditions needed for the next major move. The sharpness and speed of these raids are designed to create panic and emotional reactions. Traders with stops in predictable places are forced out of the market, while those chasing breakouts are baited in just before the reversal. For the trader who understands liquidity pools and raids, these moves are no longer confusing or frustrating. They become opportunities to observe smart money's intent, anticipate the true move, and position accordingly. The key is to stop seeing breakouts and breakdowns as signals to enter impulsively and instead view them as likely traps engineered to gather liquidity before price moves decisively in the intended direction. Stop runs and inducements. Stop runs and inducements are among the most powerful tools smart money uses to manipulate price, gather liquidity, and position themselves for major moves. To the untrained eye, These actions appear as sudden, chaotic spikes or breakouts. But in reality, they are deliberate tactics designed to force retail traders into poor decisions, creating the liquidity that institutions need to enter or exit large positions invisibly. A stop run occurs when price is driven beyond a key high or low with the specific intent of triggering stop-loss orders. Retail traders are taught to protect their trades by placing stops just beyond swing points, trend lines, or obvious support and resistance levels. This practice, while logical in theory, makes their stops highly visible to smart money. Institutions know where these stops sit, and they understand that triggering them unleashes a surge of market orders that provides instant liquidity. A stop run might manifest as a sudden spike above a swing high, causing short sellers' stops to be hit, or a sharp push below a swing low that takes out long trader stops. Once these stops have been cleared and the necessary liquidity has been captured, price often reverses sharply, leaving those caught in the stop run in losing positions. To the retail trader, this move feels like a betrayal by the market. To smart money, it is simply business, an efficient way to fuel their next phase. Closely related to stop runs are inducements. Inducements are price movements designed to tempt traders into the market at precisely the wrong time. Where a stop run flushes traders out of positions, an inducement lures them in. Smart money uses inducements to create a false sense of opportunity or security. For example, price may appear to respect a support or resistance level repeatedly, encouraging traders to believe the level is strong and reliable. As confidence builds, more traders enter the market with the expectation that price will continue to respect the level. But at the moment when the majority is most committed, smart money drives price through that level, triggering stops, filling their own orders, and often reversing the market shortly after. Inducements can also take the form of convincing but ultimately false breakouts. Price may break through a key level just far enough to draw in breakout traders only to reverse and leave them trapped. The goal of an inducement is simple: to encourage traders to act emotionally, to buy high, sell low, or place stops in predictable spots so that smart money can exploit this behavior. For the trader who understands the mechanics of stop runs and inducements, these moves are no longer sources of confusion or frustration. Instead, they become signals of where liquidity has been collected, where traps have been set, and where the true direction of price is likely to emerge once the deception is complete. Chapter 4. Order Blocks and Institutional Zones. Order blocks are among the most powerful footprints smart money leaves on the chart. To the retail trader, they may appear as just another candle or price zone, but to those who understand institutional activity, order blocks reveal where large players have entered the market with intent. These zones mark areas where smart money accumulated or distributed positions before a significant price move. They show where institutions took control, and as such, they provide valuable clues for traders seeking to align with the forces that truly drive price. What are order blocks? Order blocks are the clearest visible footprints of institutional activity on a price chart. They represent zones where large players, the banks, funds, and other smart money entities have entered the market with significant volume, preparing to drive price in a specific direction. At first glance, an order block might appear to be nothing more than the final bullish or bearish candle before a sharp move. But behind the candle lies the hidden story of accumulation or distribution. Institutions, due to the sheer size of their positions, cannot enter or exit the market all at once without revealing their hand or causing dramatic slippage. Instead, they build positions quietly in these zones, absorbing liquidity until they are ready to expand price powerfully in their intended direction. A bullish order block forms at the end of an accumulation phase. It is usually marked by the last bearish down candle before price makes an aggressive move upward. This bearish candle is not random. It is where institutions were filling buy orders while the market appeared weak, trapping sellers and creating the fuel for a bullish run. A bearish order block, in contrast, marks the end of a distribution phase. It is the final bullish up candle before a significant downward move. In this case, institutions were filling sell orders while retail traders were encouraged to buy, just before price dropped sharply. Order blocks are not just historical markers of what has already happened. They are zones of interest that often remain relevant long after price has moved on. When price revisits these areas, it frequently reacts in a meaningful way. This is because the institutions that built positions there may still have unfilled orders or may choose to defend their original entries, causing price to respect the zone. For traders who understand how to identify order blocks and interpret their significance, these zones offer high-probability opportunities to trade in alignment with the market's true power, not against it. How to identify valid order blocks? Identifying valid order blocks is a skill that separates traders who simply mark candles on a chart from those who can truly read and align with smart money intentions. Not every bullish or bearish candle before a sharp move qualifies as an order block. A valid order block reflects the precise zone where institutions accumulated or distributed large positions before driving price in their desired direction. The key to spotting these zones lies in understanding context, confirmation, and the characteristics of the move that follows. The first clue to a valid order block is the nature of the price move that comes after it. A genuine order block will precede an impulsive, decisive move that breaks market structure, clears liquidity, or leaves behind a fair value gap. This strong movement signals that institutions were behind the move. It shows intent, not random volatility. For example, if price forms a final bearish candle and then surges upward, breaking through a prior lower high or sweeping a liquidity pool, the last bearish candle is likely a valid bullish order block. The same is true in reverse, a final bullish candle followed by a sharp drop that breaks structure to the downside or clears a swing low points to a valid bearish order block. Another important characteristic is that valid order blocks tend to occur after a period of consolidation, accumulation, or manipulation. Institutions accumulate positions when price is moving sideways, trapping retail traders into false moves or luring them into the market in the wrong direction. The order block marks the end of this phase, the moment when enough liquidity has been gathered and price is ready to expand. A valid order block often aligns with the completion of this trap phase as price shifts from quiet accumulation to aggressive expansion. The size and precision of the block also matter. Valid order blocks are typically well-defined zones. They do not cover an excessive number of candles, nor are they spread across wide, erratic price ranges. Narrow, clean blocks represent areas where orders were focused. The cleaner and more compact the zone, the more likely it is to produce a meaningful reaction when price returns. Finally, the true test of a valid order block comes when price revisits the zone. Valid order blocks have a high probability of holding on the first retest, as institutions either defend their original positions or complete unfilled orders. If price returns and respects the zone, reacting with a sharp move away, it confirms the validity of the block. In this way, identifying valid order blocks is not just about marking candles in hindsight, it is about reading the intent behind price action and recognizing where smart money has left its mark on the chart. Using order blocks for entries and exits. Once a trader understands how to identify valid order blocks, the next step is learning how to use these zones for precise, high-probability entries and exits. Order blocks are not just historical markers of where smart money acted, they are dynamic zones that often continue to influence price action long after the initial move. When used correctly, they can help traders align with institutional flow, improve entry timing, set logical stop placements, and define realistic profit targets. For entries, order blocks act as key zones where traders can look to join the market in the same direction as smart money. After a valid order block forms, meaning price broke structure or cleared liquidity with conviction, traders watch for price to return to the block. This return is often a retracement, a pullback to the area where institutions originally accumulated or distributed. A bullish order block, for example, forms the foundation for a potential long entry when price returns to the zone. The trader can look for additional confirmation within the block, such as rejection wicks, refined lower time frame breaks of structure, or smaller inducements designed to clear out weak hands before the true move begins. In this way, the order block acts as a magnet for price and a launch pad for the next leg. Bearish order blocks work in the same way for short entries. When price revisits a bearish block after a sharp move lower, it often provides an ideal opportunity for the trader to enter a short position, anticipating that smart money will once again defend this zone to drive price further down. By waiting for price to return to an order block rather than chasing impulsive moves, the trader benefits from better risk-reward ratios and enters at levels where the probability of success is higher. Order blocks are also powerful tools for planning exits. Since price often gravitates toward opposing order blocks on its journey, a bullish move targeting a bearish block or a bearish move seeking a bullish block, these zones provide logical points to take profit. When trading long from a bullish order block, a trader can target the next significant bearish order block above, knowing that this is where opposing institutional interest may emerge. Similarly, a short from a bearish block can reasonably aim for a bullish block below where price is likely to encounter buy-side interest. Stop placement becomes more strategic when using order blocks. Instead of placing stops randomly or at arbitrary distances, traders can set stops just beyond the boundaries of the order block. If price invalidates the block by moving decisively beyond it, this is a clear sign that the institutional plan tied to that zone has failed and the trader can exit with discipline. This method reduces unnecessary stop-outs and helps the trader stay in the trade when price is simply retesting or accumulating before the true move. In short, order blocks provide a framework for thoughtful trading, helping traders enter where institutions entered, exit where institutions may oppose the move, and protect themselves using logical, structure-based stop levels. By integrating order blocks into their strategy, traders stop guessing and start aligning their decisions with the true power behind market moves. Chapter 5. Imbalances and Fair Value Gaps. Price rarely moves through the market in a perfectly balanced and orderly fashion. Instead, it often surges in one direction with force, leaving behind gaps where buyers and sellers did not meet evenly. These gaps are called imbalances, and they provide critical insight into smart money activity. Imbalances reveal moments when one side of the market, either buyers or sellers, overwhelmed the other so decisively that price moved too quickly for proper matching of orders. These areas of inefficiency are not simply technical quirks, they are footprints of institutional momentum. Price tends to return to these zones later, seeking to rebalance where trading was incomplete. For the trader who understands imbalances, these gaps offer a roadmap for anticipating where price is likely to revisit before continuing its journey. What is imbalance? An imbalance occurs when price moves so decisively in one direction that it leaves behind a zone where there was little to no trading activity between buyers and sellers. It is the market's visible proof that one side, either buyers or sellers, dominated the order flow, overwhelming the other side in a way that price surged or dropped without much resistance. In balanced price movement, buyers and sellers interact at each price point, creating an orderly auction where supply and demand are evenly matched. But when an imbalance forms, that harmony is broken. Price accelerates, often leaving behind wide candles or gaps between wicks where no proper two-sided trade took place. These zones of inefficiency are what traders refer to as imbalances, and they are critical to understanding the intentions and footprints of smart money. Imbalances are often created by institutional activity. When large players enter the market with size, they do not trickle into positions like retail traders might. Their orders are so significant that they cause price to move rapidly as their volume consumes available liquidity in one direction. The result is a swift, often aggressive move that leaves a void, a price area that was skipped over or thinly traded. These imbalances are easy to spot when you know what to look for: a sharp bullish or bearish candle that leaves a visible gap between the wicks of surrounding candles, or a zone where price did not pause or trade back and forth. Importantly, imbalances are not just scars left on the chart. They are magnets for future price action. Because the market seeks to balance itself over time, price often returns to these inefficient zones to complete unfinished business, filling in the gap where orders were left unmatched. For the trader, identifying these imbalances provides a roadmap for where price may be drawn in the future. When combined with other smart money concepts, such as market structure shifts, order blocks, and liquidity pools, imbalances help tell the story of where price has been manipulated by institutions and where it is likely to revisit before making its next move. The role of fair value gaps, FVGs. Fair value gaps, FVGs, play a critical role in revealing the true dynamics of institutional price delivery. An FVG represents a moment when price moved so rapidly and imbalancedly that it failed to offer a fair opportunity for both buyers and sellers to transact. These gaps form when one side, either buyers in a bullish move or sellers in a bearish move, overwhelms the other, causing price to surge or collapse in a way that leaves a void between certain price levels. On the chart, an FVG is typically identified within a three-candle sequence where the middle candle's body is so large and forceful that it creates a visible gap between the first and third candle's wicks. For example, in a bullish FVG, there will be a gap between the second candle's low and the third candle's high, a clear sign that price skipped levels as it expanded upward. The role of these gaps goes beyond simply marking where price moved quickly. FVGs highlight zones of inefficiency, areas where smart money acted with strength and urgency, leaving price unbalanced. Because the market operates as an auction-seeking equilibrium, these inefficient zones act like magnets for price, drawing it back to fill the gap and restore balance. Smart money uses this dynamic to its advantage. Institutions will often create these gaps deliberately as they accumulate or distribute, knowing that price will likely return to the zone later, providing them with another opportunity to complete orders or manipulate sentiment. For traders, fair value gaps offer powerful clues for planning entries, exits, and understanding price intent. When price leaves behind an FVG during a strong move, it signals an area of interest that may serve as a retracement target. Price is often drawn back to these gaps before continuing in its original direction, offering high-probability opportunities for traders who patiently wait for price to revisit and react to these zones. When combined with other smart money concepts like order blocks, liquidity pools, and market structure shifts, FVGs provide confluence, increasing confidence that a zone is meaningful and worth trading from. Rather than chasing impulsive moves, traders who understand the role of fair value gaps can anticipate where price will return, align themselves with institutional flow, and trade with precision rather than emotion. How price interacts with inefficiency. When price interacts with inefficiency, the gaps or voids left behind by imbalanced moves, it does so with purpose, not by chance. These inefficient zones, such as fair value gaps, represent unfinished business in the market. They mark levels where price moved too quickly for buyers and sellers to transact in balance, leaving behind an area where orders were skipped or unmatched. Because the market functions as a constant auction seeking equilibrium, price is naturally drawn back to these zones in an effort to fill the gap and restore balance. This behavior is not random volatility. It is the market's mechanism for revisiting zones where liquidity was left behind or where institutional players may have unfilled orders waiting. When price returns to an inefficient zone, several outcomes are common. Often, price will revisit a fair value gap during a retracement, tap into the zone, and then resume its original trend direction. This is where smart money may look to reaccumulate or add to positions, using the inefficiency as an entry point because it reflects an area where their original momentum began. In these cases, the reaction from the gap is often swift and precise, as institutions defend the zone to protect their prior positions or to complete the process of filling large orders that were only partially filled during the initial surge. For the trader, this interaction provides a clear opportunity. By waiting for price to return to inefficiency, they can enter in alignment with smart money rather than chasing price after it has moved too far. Sometimes price will partially fill an inefficient zone, only wicking into the gap without fully closing it before reversing. Other times, price will retrace deeper and completely fill the fair value gap before making its next directional move. The depth of the fill often depends on the strength of the trend, the surrounding liquidity, and whether additional inducements or liquidity raids are needed before smart money is ready to move price again. What remains consistent is that inefficiencies act as magnets. Price gravitates toward them because they are areas where the auction process was incomplete. Importantly, price rarely leaves significant inefficiencies unaddressed for long, especially on higher time frames. Large fair value gaps or imbalances left by institutional moves tend to attract price back over time because the market seeks to rebalance itself. Traders who understand this behavior stop viewing retracements as threats or signs of reversal. Instead, they see them as natural and necessary part of the market's rhythm as it fills in inefficiencies and prepares for its next phase. By integrating this understanding into their trading plan, traders can stop reacting emotionally to pullbacks and start using inefficiency zones as precise areas to enter, exit, or manage risk with confidence. Chapter 6. Optimal Trade Entry, OE, and Fibonacci. In the world of smart money trading, precision is everything. One of the most powerful tools ICT traders use to achieve this precision is the concept of the optimal trade entry, OE. The OE is not about guessing where price might turn or relying on indicators that lag behind. It is about aligning entries with the natural ebb and flow of the market's delivery using Fibonacci retracement levels as a guide to enter at points where the risk to reward is maximized and institutional traders are most likely to be active. The OE provides a structured, objective way to participate in the market after liquidity has been swept and price is preparing for its next expansion. The ICT OE concept. The ICT Optimal Trade Entry OE concept is a refined method that allows traders to align their entries with smart money's typical behavior during market retracements. It provides a precise, repeatable framework for entering trades at points where the balance of risk and reward is heavily skewed in the trader's favor. Rather than chasing price after it has made a significant move, the OE teaches patience, encouraging traders to wait for price to return to levels where institutional traders are most likely to accumulate or re-enter positions for the next leg of the move. At its core, the ICT OE concept is built on the natural rhythm of market movement. After price breaks structure, sweeps liquidity, or shifts direction following institutional activity, it rarely continues in a straight line. Instead, price tends to retrace, pulling back to areas where unfilled institutional orders may rest or where smart money seeks to complete accumulation or distribution before resuming the trend. The OE defines a specific zone for this retracement, focusing on the Fibonacci levels between the 61.8% and 79% retracement of the impulsive move. This zone represents the optimal entry area because it aligns with where smart money typically steps back in and where price often turns with precision before expanding in the trend's direction. The OE concept also provides structure for stop placement and target setting. Since the trader is entering at a deep retracement within a smart money-aligned zone, stops can be placed just beyond the swing high or low that preceded the move, limiting risk. Meanwhile, the target is set at logical destinations where price is drawn, opposing liquidity pools, order blocks, or fair value gaps. The OE therefore offers both precision in entry and clarity in planning exits, helping traders avoid emotional decisions or impulsive trades. What makes the ICT OE concept powerful is that it is not used in isolation. It functions best when combined with other smart money concepts such as liquidity sweeps, order blocks, fair value gaps, and market structure shifts. The OE is not just about Fibonacci levels, it is about waiting for price to return to a zone where multiple pieces of smart money evidence align, creating a high probability setup. By mastering the OE, traders gain the discipline to stop chasing price and instead position themselves where smart money is likely active, dramatically improving their chances of success in the market. Example setups. To fully appreciate the power of the optimal trade entry OE concept, it helps to see how it comes to life in practical trading scenarios. Example setups demonstrate how the combination of Fibonacci retracement levels, market structure shifts, liquidity concepts, and smart money footprints creates high-probability trading opportunities. These setups show that the OE is not simply about drawing Fibonacci levels and hoping for a reversal, it is about reading price action in context and using confluence to align with institutional intent. Consider a classic bullish OE setup. The market forms a swing low after a liquidity sweep, perhaps price dips below a prior low, triggering stop losses and drawing in breakout sellers only to reverse sharply as smart money buys into that liquidity. Following the sweep, price breaks structure to the upside, creating a higher high and signaling that control has shifted from sellers to buyers. Rather than chasing price as it moves upward, the ICT trader draws a Fibonacci retracement from the swing low where the liquidity sweep occurred to the new swing high where price broke structure. Now the trader waits patiently as price retraces. When price pulls back into the OE zone between the 62% and 79% levels, the trader looks for additional confirmations. Perhaps price taps into a bullish order block, fills a fair value gap, or forms a lower timeframe break of structure within the zone. These elements together form a high-probability long setup, with a stop placed just below the swing low and a target set at the next major liquidity pool opposing order block or fair value gap above. A bearish ODE setup follows the same principles in reverse. Imagine price rallies into a prior high, sweeping buy-side liquidity and triggering stops of short sellers. Smart money uses this opportunity to distribute their positions. After the liquidity raid, price breaks structure to the downside, forming a lower low. The trader then draws the Fibonacci retracement from the swing high where the liquidity sweep occurred to the swing low where price broke structure. As price retraces into the 62% to 79% zone, the trader watches for confluence. Perhaps price retests a bearish order block, fills a bearish fair value gap, or forms a minor market structure shift downward on a lower time frame. A short entry is triggered within the OE zone with a stop just above the swing high and targets set at logical liquidity resting below, such as prior lows, fair value gaps, or opposing bullish order blocks. What makes these setups powerful is not just the use of Fibonacci, but the confluence that supports the entry. The liquidity sweep, the break of structure, the revisit of an institutional zone, and the presence of inefficiency being filled. The OTE provides the price window. Smart money concepts provide the reasoning behind why that window matters. When traders learn to combine these elements, they stop trading impulsively and start positioning themselves with precision, waiting for the market to come to them at levels where smart money is most active. Chapter 7. Time, Sessions, and Kill Zones. In smart money trading, timing is just as critical as price levels. While many retail traders focus solely on patterns and indicators, institutional traders operate with a deep awareness of time and session dynamics. The Forex and index markets, in particular, follow a rhythm dictated by global financial centers. Understanding the importance of these sessions and how to align entries with key kill zones provides traders with a significant edge. It helps them trade when liquidity is at its peak, volatility is purposeful, and institutional players are active in the market. Importance of London, New York sessions. The London and New York sessions are the heartbeat of global financial markets, and their importance in smart money trading cannot be overstated. These two sessions account for the majority of daily trading volume, volatility, and institutional activity. For traders who aim to align with the flow of smart money, understanding the unique character of each session is essential because this is when the market's most meaningful and purposeful price moves are engineered. The London session, which opens around 2 a.m. New York time, represents the first major injection of liquidity for the trading day. As Europe's financial centers come online, banks, hedge funds, and institutions begin executing their plans, often setting the tone for the entire day. The London session is known for establishing either the daily high or low, as it is during this period that smart money frequently conducts liquidity raids, sweeping key swing points to trigger stop losses, trap retail traders, and accumulate positions at favorable prices. The volatility during this session creates opportunity, but only for those who understand that these sharp moves are rarely random. Instead, they are the result of deliberate manipulation designed to clear the path for larger institutional plays. The New York session, beginning around 7 a.m. New York time, brings a second surge of liquidity and volatility. This is the period when U.S. financial institutions enter the market, adding their weight to the price action. The overlap between London and New York, typically from 7 a.m. to 10 a.m., is the most active and volatile window of the day. During this overlap, price often completes the directional move established during London, delivers continuation setups, or executes sharp reversals, depending on how smart money has positioned itself. Additionally, the New York session frequently reacts to economic data releases, news events, and market sentiment shifts, creating further opportunity for traders who understand how to interpret these catalysts through a smart money lens. Together, the London and New York sessions provide the structure and rhythm that underpin the day's price delivery. They are when smart money reveals its true intent, engineering liquidity hunts, breakouts, and traps that drive the market's most significant moves. For this reason, ICT traders focus their attention and energy on these sessions. They know that by timing their trading around London and New York, they position themselves alongside institutional order flow trading during periods when the market's movements are driven by genuine liquidity and purpose, not the low-volume chop that characterizes less active periods like the Asian session. AM/PM session splits. The division of the trading day into AM and PM session splits is a core principle in ICT methodology. It reflects the natural rhythm of institutional price delivery and helps traders understand when the market is most likely to deliver its most meaningful moves. While many retail traders view the trading day as a continuous stream of price action, smart money traders know that the day is made up of distinct phases, each with its own purpose, character, and opportunity. Recognizing and respecting these splits allows traders to focus their efforts during periods of high-probability setups and avoid the low-energy, manipulative price action that often follows major moves. The AM session, which covers the first half of the London and New York sessions, is where the market typically delivers its most aggressive and directional price action. During this window, institutions are highly active, using the surge in liquidity at session opens to execute their plans. This is when smart money engineers liquidity raids, triggers stop runs, manipulates price around key highs and lows, and establishes the directional bias for the day. The AM session is where the major swing points, the day's high or low, are often formed. For traders seeking to align with institutional flow, the AM is the prime hunting ground for high-probability entries because this is when price moves are purposeful and driven by large volumes of institutional orders. In contrast, the PM session typically sees a slowdown in momentum. Once the AM session has established the day's key liquidity events and directional bias, the PM session often shifts into a phase of consolidation, retracement, or profit-taking. Price action becomes more subdued as institutions either hold their positions into the close or prepare for the next trading day. That is not to say that the PM session is void of opportunity. There are times when the PM will deliver continuations, clean up liquidity raids, or engineered reversals, particularly around significant time markers such as the New York PM kill zone, around 1 p.m. to 3 p.m. New York time. However, in general, the PM is where traders should exercise more caution, focusing on trade management rather than seeking fresh entries unless clear smart money setups present themselves. By internalizing the AM/PM session split, ICT traders develop greater discipline. They stop wasting energy chasing low-probability setups during the quieter hours of the day and instead align their focus with the periods when smart money is active and price is most likely to deliver meaningful moves. This timing discipline helps traders avoid overtrading, improve their risk-to-reward profile, and trade in harmony with the true rhythm of the market. Ideal timing for entries. The ideal timing for entries is a concept that sits at the heart of smart money trading. In ICT methodology, timing is not simply about when price reaches a certain level, it's about when price is most likely to deliver a clean, high-probability move with institutional backing. This ideal timing emerges when price, liquidity, and time come together during the most active and purposeful parts of the trading day. By learning to synchronize their entries with these windows, traders can dramatically improve their success rate, reduce the likelihood of being caught in consolidations or fakeouts, and trade in harmony with the market's true drivers. The foundation of ideal timing lies in the kill zones, those specific periods during the London and New York sessions when smart money is most active. During these windows, typically the London Open 2 a.m. to 5 a.m. New York time, and New York Open 7 a.m. to 10 a.m. New York time, institutions are entering, exiting, and manipulating positions with size. This is when price often makes decisive moves, raiding liquidity pools, breaking structure, and delivering expansion moves that set the tone for the rest of the session. Traders who focus on these kill zones for their entries align themselves with the periods when the market is most likely to move efficiently, reducing the noise and frustration that often accompanies low-volume hours. However, timing is not about kill zones alone. The ideal entry occurs when time aligns with context. It is not enough to enter simply because the clock says it is London or New York Open. The trader waits for the market to deliver the setup, a liquidity sweep, a break of structure, a market structure shift, or price returning to a key institutional zone such as an order block, fair value gap, or optimal trade entry, OE, level. The convergence of these technical factors within the right time window creates the ideal moment to strike, where smart money is active, liquidity has been engineered, and the path is clear for price to expand. Another critical element of ideal timing is patience. ICT traders do not force trades at the start of a kill zone or during a session simply because they want to be active. Instead, they allow price to unfold to reveal where smart money is operating and to provide confirmation before committing capital. This patience often means waiting through the first manipulation or false move of a kill zone, then entering on the retracement or secondary move when the true directional intent becomes clear. Ultimately, ideal timing for entries is about precision. It is about entering when the market is primed to move with purpose, when institutional players are engaged, and when price is offering the trader the greatest possible risk-to-reward opportunity. By mastering timing, the trader stops fighting the market's natural flow and starts trading in concert with it, dramatically increasing their chances of long-term success. Chapter 9. Combining ICT concepts into a trading plan. Mastering individual ICT concepts like market structure, liquidity, order blocks, fair value gaps, and optimal trade entry is powerful. But true consistency in trading comes when these elements are woven together into a clear, structured trading plan. A well-defined plan serves as both a roadmap and a filter, guiding the trader toward high-probability setups while protecting them from impulsive decisions and market noise. When ICT concepts are combined into a cohesive system, traders gain the clarity and discipline needed to operate in alignment with smart money and to execute trades with precision and confidence. Step-by-step setup checklist. A step-by-step setup checklist is the backbone of an ICT trader's plan. It transforms complex concepts into a repeatable process that keeps the trader focused, disciplined, and aligned with smart money principles. This checklist serves as both a guide and a safeguard, helping the trader filter out poor quality setups and ensuring that every trade taken meets strict, objective criteria. Below is how a complete ICT setup unfolds, step by step. 1. Establish the daily bias. The first task is to determine whether the market is more likely to trade higher or lower during the session. This bias is shaped by higher timeframe market structure, recent breaks of structure, liquidity sweeps, and the position of price relative to key institutional levels. Is the market in a premium or discount zone on the daily or 4-hour chart? Has there been a raid on buy-side or sell-side liquidity that suggests price is ready to reverse or expand in the opposite direction? The daily bias sets the foundation for the day's trade plan, and without it, every setup becomes guesswork. 2. Identify key liquidity pools. Next, the trader marks out the major sources of liquidity that smart money is likely targeting. These include obvious swing highs and lows, equal highs or lows, session highs/lows, and areas where stops are likely resting. Knowing where liquidity is resting helps the trader anticipate where smart money will engineer raids and manipulate price before making its true move. 3. Map institutional zones, order blocks, fair value gaps. With liquidity mapped, the trader highlights zones where smart money is likely to engage, order blocks, fair value gaps, FVGs, imbalances, and optimal trade entry, OE, levels. These zones represent price inefficiencies or footprints of institutional accumulation and distribution. They act as magnets for retracements and as platforms for expansion moves. 4. Wait for a liquidity raid or inducement. Before entering, the trader waits for price to sweep a key high or low, triggering stops and creating the fuel for the next leg. This step is crucial. It ensures that the trader is not entering ahead of smart money's manipulation, but after the trap has been set and sprung. 5. Confirm market structure shift or break of structure. Following the raid, the trader looks for price to confirm intent through a break of structure, BS, or a market structure shift, MSS. This is the technical signal that smart money has flipped direction and is now ready to expand away from the engineered liquidity. 6. Refine entry using OE or zone touch. The trader refines the entry by waiting for price to return to a key zone within an optimal trade entry ODE region, typically the 62% to 79% Fibonacci retracement, or to tap back into an order block or fair value gap. This step ensures that the trader enters at a point of maximum efficiency where risk is minimal and potential reward is greatest. 7. Time the entry within the kill zone. All of this preparation culminates in an entry that occurs during a high-probability window, the London or New York kill zone, when institutional players are most active. The trader avoids off-session trades where liquidity and intent are low, focusing only on moments when price is likely to deliver. 8. Set stop loss at logical invalidation point. Once the entry is taken, a stop loss is placed just beyond the level that, if broken, would invalidate the setup. For example, in a bullish setup, this may be just below the low of the liquidity sweep or order block. This protects capital while allowing the trade enough room to breathe. 9. Define the target. The trader sets a clear, objective target, typically the next opposing liquidity pool, order block, or imbalance. Targets are chosen based on where price is logically drawn next, not on arbitrary profit goals. 10. Execute with discipline. Finally, the trader executes the plan without hesitation or deviation. No second-guessing. No moving stops or targets on a whim. The plan is followed with precision, knowing that consistency over time, not perfection on every trade, is what produces long-term success. Risk management the ICT way. Risk management is the silent engine behind every successful ICT trader's plan. While most traders fixate on finding the perfect entry, those who follow smart money concepts know that managing risk with precision is what truly determines long-term success. The ICT approach to risk management is not about fear or trading defensively, it is about controlling exposure with the same discipline and structure used to identify high-probability setups. It ensures that no single trade or losing streak can derail the trader's account and that capital is preserved so the trader can fully capitalize when the market delivers clean, institutional moves. At its core, risk management the ICT way starts with defining the risk per trade as a percentage of the total account balance. Most ICT traders typically risk no more than 1% and often less on any given trade. This conservative risk allows the trader to withstand inevitable drawdowns without significant emotional stress or damage to their account. By keeping risk consistent, the trader avoids the dangerous trap of over-leveraging after a win or attempting to make back a loss with oversized positions. The key is steady, methodical exposure where risk is measured and applied only to the highest quality setups. An important feature of ICT risk management is precision in stop placement. Stops are never placed randomly or based on arbitrary pip counts. Instead, they are positioned at logical invalidation points, usually just beyond the high or low of the liquidity sweep, order block, or zone that anchors the setup. This reflects smart money logic. If price violates that level, it signals that the setup's premise is invalid and the trader exits without hesitation. This approach minimizes unnecessary stopouts from normal price fluctuations while ensuring that risk is tightly controlled if the market proves the setup wrong. Another critical layer is the asymmetric risk-to-reward philosophy that underpins ICT trading. The goal is to risk a small, controlled amount on each trade, for example 0.5% to 1%, while aiming for much larger returns when the trade works out. By targeting logical destinations where price is drawn, such as opposing liquidity pools, order blocks, or fair value gaps, the ICT trader looks for setups that can deliver 2, 3, or more times the initial risk. Over time, this asymmetry means that even with a modest win rate, the trader's account can grow consistently because the math of the plan is tilted in their favor. ICT risk management also emphasizes consistency over outcomes. Losses are part of the process. Smart money traders understand that not every setup will work and they do not measure their success by the result of any single trade. Instead, they focus on the quality of their execution and the discipline of following the plan. A trade that hits the stop but was entered according to all the plan's rules is considered a good trade because it reflects adherence to the system, not an emotional or impulsive decision. Finally, risk management in ICT is deeply tied to psychological resilience. Because the trader risks only small, controlled amounts on high-quality setups, they are less likely to experience the emotional turmoil that leads to poor decisions, such as revenge trading or abandoning the plan. This structure gives the trader confidence, clarity, and the ability to think like smart money. Focus not on any one outcome, but on consistency over a series of trades where the edge plays out over time. Psychology and discipline. In trading, the difference between long-term success and failure often has less to do with technical knowledge and more to do with psychology and discipline. For the ICT trader, this truth is especially significant. The tools and concepts of smart money trading, from liquidity sweeps to order blocks and kill zones, provide the map. But it is the trader's mindset and ability to stay disciplined that determines whether they follow that map or veer off course when emotions take over. A robust trading plan can only be as strong as the mental state of the person executing it. One of the core psychological principles of ICT trading is patience. Smart money does not rush into the market, nor should the trader. Institutions wait for the precise moment when liquidity has been engineered and conditions are optimal before committing their capital. The disciplined trader mirrors this mindset, waiting through consolidations, manipulations, and false moves, only acting when all conditions of the plan align: time, liquidity, structure, and zone. The lack of patience, the urge to force trades or jump in too early, is often what causes traders to give back hard-earned profits or suffer unnecessary losses. True discipline comes from trusting that the market will provide and that there is no need to chase. Closely tied to patience is the ability to accept losses with professionalism. In the ICT approach, a loss is not a personal failure, it is simply a cost of doing business, part of the statistical edge playing out over time. The disciplined trader does not panic, overreact, or deviate from the plan because of a single losing trade or even a string of them. They review, refine, and stay focused on execution quality rather than becoming emotionally attached to outcomes. This mindset shields the trader from the dangerous cycle of revenge trading, overleveraging, or abandoning proven strategies in a moment of frustration. Another vital psychological trait is confidence through preparation. ICT traders do not rely on hope or intuition, they rely on their process. When a trader has done the work, mapping liquidity, defining bias, planning the setup, calculating risk, they enter trades knowing that they are aligned with smart money logic. This preparation breeds confidence, and that confidence sustains discipline in the heat of live trading. Instead of reacting emotionally to every price tick, the prepared trader can calmly assess whether the market is delivering according to plan or whether it's time to step aside. Finally, discipline in ICT trading means sticking to the plan without compromise. This includes taking trades only during designated kill zones, only at validated zones of interest, only after proper liquidity engineering, and only with predefined risk and target levels. It means not moving stops unnecessarily, not cutting winners short out of fear, and not adding to losers in the hope of recovery. The trader who masters this level of self-control gains a powerful advantage: the ability to trade with the same calm precision that smart money itself displays. Ultimately, psychology and discipline are what turns smart money concepts from theory into consistent performance. They allow the trader to think and act like a professional, one who operates with clarity, patience, and precision, no matter how the market moves. Chapter 9. Case Studies. The true value of ICT concepts comes to life when applied in real market conditions. While theory builds understanding, it is through detailed case studies that traders see how smart money principles play out in the charts and how precise, disciplined execution transforms ideas into results. In this chapter, we walk through real-world examples of trades that followed the ICT blueprint, breaking down each element, from liquidity engineering to structure shifts, entry precision, risk management, and exit logic. These examples show that success in smart money trading is not about luck or prediction, but about reading price action with clarity and aligning with institutional intent. Detailed analysis of real trades, charts plus breakdown. One of the most powerful ways to internalize ICT concepts is through the detailed analysis of real trades, where theory meets the realities of live market dynamics. While understanding the individual components of smart money trading, like liquidity sweeps, order blocks, fair value gaps, and kill zones provides the foundation, it is through case-by-case breakdowns that these concepts come alive. These analyses allow traders to see how a complete setup unfolds from start to finish and how each element contributes to building a high-probability trade that aligns with institutional intent. Each case study begins with the higher timeframe context. Before focusing on any entry, we study the daily or 4-hour structure to identify the overall bias. Is the market delivering price into a premium or discount zone? Where are the resting pools of liquidity on the higher time frame, equal highs, equal lows, previous week's high or low, or major swing points? Mapping these key levels gives us the framework to anticipate where smart money is likely to act and where price is likely to be drawn. Next, we break down how liquidity is engineered. The charts reveal how price manipulates retail positioning, sweeping a key high or low, triggering stop orders, or baiting breakout traders just before reversing. This liquidity grab is a hallmark of smart money activity, and each case study highlights how to spot the traps laid for uninformed traders. We show where the stop runs occur, what clues the price leaves behind, and how the trap sets the stage for the real move. Following the liquidity raid, we focus on the confirmation. This is where price delivers a break of structure, BS, or market structure shift, MSS, signaling that smart money has completed its accumulation or distribution and is now ready to drive price in the true intended direction. Our chart breakdowns show how these breaks form, how to validate them across timeframes, and how to avoid false signals. With the confirmation in place, the analysis then zeroes in on entry precision. We illustrate how price retraces to an optimal trade entry, OTE zone, returns to test a significant order block, or fills a fair value gap, offering the trader the ideal location to enter with tight risk and maximum reward potential. The entry is always timed within kill zones, London AM or New York AM sessions, when smart money is active and price is likely to expand cleanly. Finally, we dissect the exit strategy. The charts show how targets are selected not at random, but at logical destinations. Opposing liquidity pools, unfilled fair value gaps, or key institutional zones where price is likely to stall or reverse. Stop placements are explained in detail, demonstrating how they protect the trader's capital while allowing the trade enough room to develop naturally. Throughout each case study, every key decision point is broken down. Why was the bias set as bullish or bearish? What made this liquidity sweep significant? How was the confirmation validated? Why was this entry point superior? Where was risk managed and how were targets chosen? By walking through these questions in each example, the trader learns to think like smart money, seeing beyond surface-level price action and focusing on the deeper story that the market is telling. These detailed analyses serve as both education and blueprint. They show what disciplined, smart money-aligned trading looks like in practice, while also training the trader's eye to recognize the same patterns and opportunities in live markets. Each chart, each breakdown, and each decision point builds the trader's skill and confidence, moving them closer to consistency and long-term success. Common mistakes beginners make with ICT. When new traders first encounter ICT concepts, they are often drawn to the precision and logic of smart money trading. However, the transition from theory to practice can be challenging. Without discipline and patience, beginners can fall into common traps that lead to frustration, losses, and inconsistency. Understanding these typical mistakes helps traders recognize and avoid them, accelerating their journey toward mastery. One of the most frequent errors is entering too early without confirmation. Eager to catch what looks like a smart money setup, beginners often jump into trades right after spotting a liquidity sweep. They see price rate a key high or low and assume the move is ready to reverse. But without waiting for the essential confirmation, a break of structure or market shift, they often get caught in further manipulation. Smart money will frequently sweep liquidity multiple times or continue running stops deeper before showing its true hand. Entering on the first sign of a raid, without evidence that direction has truly shifted, leaves beginners vulnerable to premature losses. Another common mistake is misreading market structure. Beginners sometimes identify breaks of structure or shifts where none exist, often because they are focused too narrowly on small time frames. This can lead to chasing false moves that don't align with the higher timeframe bias. For example, they might spot what looks like a bullish shift on a 1-minute chart while the 15-minute or hourly structure remains bearish and dominant. Failing to anchor decisions to the higher timeframe context leads to entries that go against the true flow of smart money. A related pitfall is overcomplicating setups. In an effort to apply all the concepts they've learned, beginners may clutter their charts with too many tools, multiple Fibonacci levels, overlapping order blocks, fair value gaps, and countless liquidity lines, until their analysis becomes confusing rather than clarifying. Instead of focusing on clean, high-probability confluence, they try to force too many elements into a single trade idea, leading to hesitation, second-guessing, and missed opportunities. Trading outside kill zones is another error that undermines consistency. Beginners, excited by price movement, often take setups during off-hours, the Asian session, or the PM lulls of London and New York, when institutional activity is low. Without the liquidity and intent that characterize the kill zones, these trades are more prone to choppy, aimless price action that can stop out positions or trap traders in drawn-out consolidations. Understanding when to trade is as vital as knowing where and why to trade. Poor risk management is also a hallmark of inexperience. Beginners sometimes place stops too tight, getting stopped out by normal price noise, or too wide, risking far more than necessary. Others skip proper risk calculation altogether, trading oversized positions out of excitement or fear of missing out. Without clear, logical stop placement and controlled position sizing, even a good setup can become a costly error. Finally, emotional trading driven by impatience, fear, or the desire to recover losses leads beginners to abandon their plan. They may move stops after entry, cut winners short out of anxiety, or chase price after missing the optimal entry zone. These emotional reactions not only erode consistency but also disconnect the trader from the disciplined, calculated mindset that smart money trading requires. By becoming aware of these common mistakes, beginners can approach ICT concepts with greater mindfulness and professionalism. Success in smart money trading is not just about knowing the concepts, it's about applying them with clarity, discipline, and patience, avoiding these traps and focusing on quality over quantity in every decision made. Chapter 10. Building Your Edge. Mastering ICT concepts is not a one-time event. It is a journey of refinement, observation, and applied learning. While understanding smart money theory provides the foundation, your true trading edge is built through practice, reflection, and deliberate review of your own performance. The trader who commits to journaling trades, methodically backtesting strategies, and steadily developing confidence in the concepts gains something more valuable than any single setup. They gain mastery of the process itself. This chapter explores how to actively build that edge so your trading evolves from knowledge to consistent execution. Journaling ICT trades. Journaling ICT trades is one of the most powerful habits a smart money trader can develop. It transforms every experience, win, loss, or break-even, into a lesson that sharpens your edge and accelerates your growth. In the world of ICT trading, where precision and discipline are paramount, a well-maintained trading journal helps you bridge the gap between theory and execution. It keeps you accountable, reveals patterns in your behavior and decision-making, and provides objective feedback that no indicator or external mentor ever could. A proper ICT trading journal goes beyond the basics of logging entry price, stop loss, and take profit. It captures the full context of each trade, which is vital when working with smart money concepts. This means recording your higher timeframe bias. What was your directional expectation based on the daily or 4-hour structure? Where were the major liquidity pools you identified before the trade? Did you mark out buy-side or sell-side liquidity, and were these levels swept before your entry? Which key institutional levels were in play, order blocks, fair value gaps, imbalances, or optimal trade entry zones? This level of detail helps ensure that every trade you take aligns with smart money principles and not random price action. Just as important is noting the confirmation signals you waited for before pulling the trigger. Did you see a clear break of structure, BS, or market structure shift, MSS? Was the entry within the appropriate kill zone? Did price return to the zone you had mapped, such as an order block or fair value gap? Or did you jump in without waiting for proper retracement? Writing these details forces you to assess whether you followed your plan with discipline or allowed emotions to interfere. In addition to the technical components, your journal should capture the psychological aspect of your trade. Were you patient, or did you rush the entry out of fear of missing out? Did you second-guess your plan as price moved, or did you manage the trade calmly according to your rules? How did you feel before, during, and after the trade? Over time, these notes will expose patterns. Perhaps you tend to exit early out of fear, or you're prone to chasing price during low-probability hours. The journal becomes your mirror, reflecting both your strengths and the areas where further discipline is needed. Another valuable component of journaling is post-trade reflection. After each trade, take time to review the outcome and context. If the trade worked, was it because your analysis was accurate and your execution precise? Or was it luck, a poor entry that just happened to work out? If the trade failed, did the market invalidate your setup for reasons beyond your control, or did you skip a key step in your process? This type of reflection trains you to focus on process over outcome, the mark of a true professional. Finally, a well-organized journal provides a growing library of personal case studies that you can review regularly. By studying your own trades, both successful and unsuccessful, you build deeper confidence in ICT concepts because you see how they played out in your hands. You begin to spot recurring patterns in the market and in yourself, gaining clarity on how to refine your execution and strengthen your edge. In short, journaling ICT trades is not just about recording what happened. It is about actively engaging with your process, holding yourself accountable, and turning every trade into a stepping stone toward mastery. Backtesting tips for ICT strategies. Backtesting is a critical tool for building confidence in ICT strategies and sharpening your edge as a smart money trader. Unlike random historical chart browsing, purposeful backtesting is a structured exercise designed to help you internalize key concepts, refine your eye for high-probability setups, and develop trust in your plan, all without risking live capital. For ICT traders, where timing, structure, and liquidity are central, backtesting must go beyond simple entry and exit points. It must simulate live trading conditions, reinforcing the discipline, patience, and precision that define smart money execution. The first tip in backtesting ICT strategies is to always start with a higher timeframe context. Before you scroll back on a chart or hit replay mode, map out the daily and 4-hour bias. Identify major swing highs and lows, clear buy-side and sell-side liquidity pools, premium and discount zones, and key institutional levels like order blocks and fair value gaps. This mirrors the preparation you do in a live session and trains your brain to think top-down rather than jumping straight to entries on lower time frames. Next, replay price bar by bar or candle by candle, just as you would see it live. Avoid the temptation to fast-forward through price action to find the good spots. The purpose of backtesting is not to hunt for perfect trades, but to practice reading price as it unfolds, with the same patience you'd exercise in live conditions. Let price develop through kill zones. Watch how liquidity is engineered, observe the manipulation, and wait for confirmation like a break of structure, BOS, or market structure shift, MSS. Before determining where and how you'd enter. Another essential tip is to log every backtest trade in a journal just as you would in a live account. Record the bias, liquidity map, time of day, kill zone, setup type, order block, FVG, OE, etc., confirmation, entry logic, stop placement, and target. Afterward, review the trade objectively. Did you follow the process or did you rush the setup? Did price behave as expected after the liquidity raid? Where could you improve your precision or patience? This process transforms backtesting from passive observation into active learning. It is also important to simulate realistic trade management during backtesting. Don't just mark an entry and target. Practice placing stops at logical invalidation points, managing partials at key levels, and holding for full targets when appropriate. If you are too lenient or too aggressive with risk and targets during backtesting, it will be harder to translate those lessons to live trading. Finally, build a library of backtested examples. Save your marked-up charts with notes detailing the setup, context, and outcome. Over time, you'll accumulate a personalized database of ICT model trades that you can review, study, and reference whenever needed. This growing library not only deepens your understanding but also builds your confidence, because you've seen these patterns repeat over and over in different market conditions, confirming the validity of smart money concepts. Effective ICT backtesting is about more than testing theories. It is about ingraining the habits of patience, precision, and disciplined execution that are necessary for success. Done properly, backtesting becomes one of the most valuable tools in your journey toward mastering the smart money approach. Developing confidence in smart money concepts. Developing confidence in smart money concepts is a vital milestone on the trader's journey and one that distinguishes consistent, disciplined ICT practitioners from those who struggle with hesitation, doubt, or emotional trading. Confidence does not come from memorizing theories or watching countless videos. It is built through direct experience, deliberate practice, and a deepening trust in both the concepts and your ability to apply them with precision. Confidence begins with understanding the logic behind smart money concepts. ICT principles such as liquidity engineering, market structure shifts, order blocks, and kill zone timing are not arbitrary ideas. They are based on how institutional players operate in financial markets, how they seek liquidity, manipulate price, and position themselves for expansions. When you study these ideas and see how they reflect the behavior of large market participants, you begin to recognize that smart money concepts are not just strategies. They are the blueprint for how the market really works beneath the surface. This foundational understanding lays the groundwork for belief in the system. However, true confidence comes through application. The more you apply ICT concepts in backtesting, in journaling, and eventually in live markets, the more evidence you gather that these principles play out repeatedly and reliably. When you see with your own eyes how price consistently targets liquidity pools, sweeps highs and lows before reversing, and respects well-defined order blocks and fair value gaps, you stop second-guessing the concepts. Instead of wondering whether a setup will work, you begin to focus on executing your plan correctly, knowing that your edge lies not in predicting every move, but in aligning with the smart money narrative. Another key to building confidence is experiencing both wins and losses without emotional turbulence. Many traders mistakenly believe that confidence comes from winning trades. In reality, it comes from seeing that your plan holds up over a series of trades, including losses, and that your risk management protects you when a setup fails. Losses become part of the process rather than personal failures, and this resilience strengthens your trust in your strategy. Over time, you begin to internalize that what matters is not any single trade, but the consistent application of your edge. Repetition and review are powerful tools in this process. By journaling your trades and studying your backtests, you build a personal archive of evidence that reinforces your understanding. You see how the market delivered clean setups that aligned with ICT principles, and where mistakes in execution, not flaws in the concepts, led to suboptimal results. The more you reflect on this archive, the more your confidence grows, because your belief is anchored in your own experience rather than outside opinions. Finally, confidence develops through sticking to the process even when results are slow. Many traders lose faith in a system because they expect instant success. But the ICT approach teaches that mastery takes time, and that consistent application through different market cycles builds lasting trust in both the strategy and yourself. Each time you follow your plan with discipline, regardless of outcome, you reinforce the habits that lead to confidence, patience, precision, and professionalism. In summary, confidence in smart money concepts is not gifted, it is earned. It grows through study, application, reflection, and the steady accumulation of evidence that these principles align with how the market truly moves. When that confidence takes root, it becomes a powerful force, one that allows you to execute with clarity, remain calm under pressure, and trade in harmony with the market's deeper currents. Conclusion: the smart money edge. As you reach the end of this journey through the principles and practices of ICT trading, one truth stands above all. Success in the markets is not about predicting the next move. It is about understanding how the market moves, why it moves, and aligning your actions with the forces that truly drive price smart money. The smart money edge is not a secret indicator or a magic formula. It is a mindset, a process, and a disciplined way of engaging with the charts. It is the ability to see beyond random price action to the structure and intent behind it. It is recognizing how liquidity is engineered, how traps are set, how institutions accumulate and distribute, and how price is drawn toward imbalance and inefficiency. It is knowing when to engage during the kill zones when the real players are active, and when to stand aside, letting low-probability noise pass you by. More importantly, the smart money edge is built on self-mastery. It is not enough to know the concepts, you must live them. That means following your plan with precision, managing risk with professionalism, and journaling and reviewing with honesty. It means learning from every trade, whether a winner or a loser, and using that feedback to refine your process rather than chase perfection. Throughout this book, you've explored the building blocks of ICT trading, market structure, liquidity, order blocks, fair value gaps, kill zones, timing, and more. You've seen how these elements come together to form a clear, repeatable framework. But knowledge alone will not deliver consistency. The edge comes from application through backtesting, journaling, and trading with discipline until these concepts become second nature. Your edge is not in trying to outwit the market or outguess other traders. Your edge is in thinking and acting like smart money. It is in being patient where others are impulsive, precise where others are sloppy, and calm where others are reactive. Over time, this edge compounds. It builds confidence, consistency, and ultimately profitability. The path of the smart money trader is not easy, but it is simple: observe, plan, execute, review, and refine. Each step strengthens your alignment with how the market truly operates. And in doing so, you move from being part of the crowd to standing alongside the professionals, those who see the market for what it is and trade with clarity, intent, and purpose. Let this be your mission as you step forward. Build your edge not just through knowledge, but through disciplined practice. Trust in the process, respect the concepts, and stay committed to growth. The smart money edge is yours to claim, one quality decision at a time. Thank you for listening to the ICT Trading Strategy Bible. I hope this guide helps you build the mindset, discipline, and precision to trade alongside smart money, not against it. If you found this valuable, please like the video, leave a comment with your thoughts or questions, and share this with other traders. Subscribe for more smart money trading guides, strategies, and case studies. Stay disciplined, stay focused, and trade smart. Until next time.